This segment sponsored by Foster Financial. Welcome back to Money Monday, where we provide you with holistic financial advice from Foster Financial. And joining me today is Caleb Doan, their Vice President. Hi, Caleb.
Hi.
Welcome.
Thanks very much.
Yes. Okay. So we're in a brand new year.
Yeah.
Can't believe it, 2025. And things change, right, as the years change. And one of those things is the 401k contribution limits. So tell us what is happening this year.
Yeah. So just about every year these get raised. They get kind of a cost of living adjustment there. So it just increases the total amount that somebody can contribute to these tax advantaged accounts.
Okay, so what they can contribute. So is that a benefit to the consumer?
Yeah, it certainly is. So I mean, you kind of wonder, why is there a limit on it in the first place? The government puts these different limits because obviously it's only the highest earners who would be able to take advantage of it if the limit was, 100 grand. But they put this limit that you can contribute to it every single year. This year they raised it a little bit. It's $23,500 that somebody can put into their 401k over the course of the year. And those who are turning 50 this year or are older get a little extra that they get to put in.
Okay, so these limits, so $23,500 applies to everyone, regardless of your age. So what was the previous limit?
Yeah, it was $23,000. So they only got a little bump there, not too crazy. Yeah. And then the catch-up contribution for those, turning 50 this year or older is an additional $7,500. So if you add that to it, you get, $31,000 that you can put in over the course of the year. And there are certainly, savers, closer to retirement, maybe they're in their higher earning years, where they do get to max out both of those buckets, which is great. There's a lot of people, though, that say, hey, I earn 75 grand a year. If I'm contributing, 23,000 or 31,000 to my 401k, my paycheck isn't enough anymore, so it's coming through payroll deduction. They'll say, if I max that out, I'm not getting enough at the end of the day. In that situation, what we look to do is we try to see if that client has just an after-tax brokerage account that maybe they've contributed to over the years. Maybe they have different stock picks in there. Because that after-tax brokerage account typically is not as tax advantaged as something like a Roth 401k. In that after-tax brokerage account that they have, you have to pay capital gains if you're selling at a gain. You have to pay interest and dividends, taxes on those things. Whereas in a Roth 401k, you don't have to pay that. And so, what we could do is we say, hey, max out the 401k, and your paycheck is going to be less now, and we'll actually replace your lost paycheck with your own brokerage account. So let's break down that a bit more as to why someone would find the benefit in a 401k over the brokerage account. Why would they put their money? And so maybe someone isn't really familiar with how 401ks work. So can you kind of break that down for a second? Yeah, so I'll talk specifically about the Roth 401k because oftentimes we have people contribute to that Roth bucket. When you contribute to the Roth 401k, you don't get to write it off of your taxes when you contribute to it. So it doesn't reduce your taxes that year. But once it's in there, as long as it's in there for more than 5 years, it grows completely tax-free and it comes out completely tax-free. So you don't owe any taxes on it.
After 5 years?
Yeah, after 5 years. It needs to be in the Roth 401k for 5 years, or the Roth 401k has to be open for at least 5 years. Whereas the after-tax brokerage account, which a lot of people have, you again contribute to it with after-tax dollars, so you don't get any tax benefit putting it in, but you have to pay taxes on interest, dividends, capital gains. There's a lot of taxes associated with those accounts. And so instead, if we increase the contributions to the 401k, replace our income with that after-tax brokerage, the end result is basically, hey, we're taking money from this account that doesn't have as many tax advantages. We're putting it in this account that the government says, hey, we're not going to charge you taxes on that. And that's what we like. If we get more money in those tax-advantaged accounts, obviously it saves clients taxes over the course of their lives.
Yeah, and it's that benefit of it being an employer account, right? So the 401k allows for people to pull directly from their payroll And then usually companies will match it to an extent.
Right.
So you want that double value. So if you apply more to the 401k, you're actually probably getting more in return too.
Yeah, absolutely. Yeah, that's kind of one of the big rules is, hey, at least contribute up to the match in your employer 401k, because that's a really big advantage. And you'll see over the course of the year, sometimes your 401k statement will even show how much company match has gone in there. And it's pretty astounding. After 10, 20, 30 years, there's several $100,000 that the employer could have contributed to that account.
Yeah, but you got to take advantage of it and learn, how these accounts work. So thank you so much for breaking these down. And so Happy New Year.
Yeah, Happy New Year.
And if you would like more information about Foster Financial, we'll have their phone number listed below, and I'll see you after the break.
This segment sponsored by Foster Financial.